besides who's speaking right now. So
Okay. Let's Heather, can you just tell us who all is on the call? Or I guess I can do that. I can scroll through the.
I can do a quorum check. I could call out the names if you would like.
Yeah. Let's do that. Why don't I go ahead and call the meeting to order, and then we'll do the roll call. Does that work?
That's fine.
All right, and just bear with me. I've lost the visual on your screen share, so just bear with me.
Okay.
I must have hit a button here that. All right, I'm almost back to where I need to be. Okay. All right. Well, let's go ahead and call the March 11th meeting of the COTPA Pension Plan Committee to order. The long-awaited makeup meeting and regular meeting, I think, all rolled into one here. And maybe before we call roll, I want to make sure I recognize Mr. Steve Lawley, who's with us today. We'll get to your part on the agenda. Thanks for being here.
You bet. Thank you. Good to see you and good to see Chris. Haven't seen him in a while.
hey, how you doing, Steve?
Very well, sir. Thank you. Say hi to Dylan for us.
And you say hi to Gary too,
Okay. Their kids grew up together.
and Mary. Yeah.
All right. Well, as we call the meeting to order, because we're meeting virtually, I have a script that I need to read. So here we go. Thanks for joining us for the Pension Plan Committee video conference. You may access the meeting from the Zoom link printed on the cover page of the agenda. So if there's anybody from the general public following along, the link is on that cover page. Only matters appearing on the posted agenda may be considered or discussed at this special meeting. The detailed packet version was posted on Monday, March 8th, 2021, and is available at okc.gov. If the teleconference is disconnected at any time during the meeting shall be stopped and reconvened once the audio connection is restored. If communications are unable to be restored within 15 minutes, items remaining for consideration will be continued either through a special meeting or at the next regularly scheduled meeting of our committee here. Anyone wishing to speak about an agenda item, please call 405-297-2484, or you may text 405-479-1615. Please provide your name, phone number, the item number, and the reason you wish to comment. If you call in after your item has been heard, you'll be allowed to speak when recognized by the chair. Residents will be allowed 3 minutes to comment. Ask that all participants keep their, except for committee members or those on the agenda, to keep their phones on mute until they're recognized to speak. And so here, okay, that concludes the script. Can you go ahead, Heather, now and let's do a roll call of committee members to see who all we have with us.
Yes, I will. Jason Fairbrother, sorry.
Present.
Thank you. Brent Bryant.
Here.
Matt Boggs.
Here.
Chris Burke.
Here.
Jack Murphy. Jesse Brown. Lamar Hammond.
Present.
Steve Lally.
Here.
Mike Shaw.
Here. I need to make note because the next item on the agenda is for Steve. So Steve won't be checked off on that first to the roll call until after we get past the second point.
Okay.
Thank you.
Okay, so Heather, based on your roll call and understanding that Mr. Lawley hasn't officially been I guess, approved by the committee, we still have a quorum to proceed?
Yes, we do. We have 6.
Okay. All right. Well, then that's going to take us to item 2 on the agenda, which is approved minutes of the COTPA pension plan held on August 20th, 2020. Do we have a motion to approve those minutes, or are there any questions or comments about the minutes from any of the committee members?
This is Mike Shaw, so moved.
Do I have a second?
Chris
Matt
Burke,
Boggs,
second.
All in favor? Aye.
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 Oh, actually, Heather, do you have to take a roll call? I'm sorry. Heather,
Yes,
do you have
I
to take
do.
a roll call on each one of these since we're
Yes.
virtual? All righty, we're ready.
All right, here we go. Jason Fairbush,
Aye.
Brett Bryant,
Aye.
Matt Boggs,
Aye.
Chris Burke,
Aye.
Jack Murphy, Jesse Brown, Lamar Hammond,
Aye.
Mike Shaw.
Aye.
Motion passes.
Okay, thank you, Heather. Item 3, approve the recommendation of Steve Lawley for the COTPA Pension Plan Committee. And just as a reminder to our committee members, our bylaws dictate the number and kind of the recommending body, if you will, for the committee membership. And we did have a vacant committee member position that we're calling the at-large committee member that both management and the ATU have discussed, and we're recommending Mr. Lawley and acknowledging and thanking Mr. Lawley for his willingness to serve on our pension committee. So what I'd like to do is get a motion to actually, maybe it'd be more appropriate if Mr. Lawley, would you like to introduce yourself? And I know a lot of us know you, but some are new names for you. Maybe give a little bit of background. I know your transit roots run deep.
Yeah, indeed, yeah. Never actually worked in the transit industry per se itself. But I had a public relations firm, operated in Oklahoma City for 26, 27 years, my first client, and stayed with me from day one till my retirement, December 31st, 2017, Oklahoma Transit Association. And so I have a background in journalism, PR, and having worked in a congressional office, state legislature. And just as Jason said, the transit roots run deep. That was, I got to know I can't even count the number of people I got to know in transit. So to be on something like this is so vitally important to people in that industry here locally, especially. It's an honor. Pleased to be considered. Thank you.
Thank you, Steve. So at this point, I'd like to see if I can get a motion to approve the recommendation of Steve Lawley for the COTPA Pension Plan Committee.
This is Matt Boggs. I move for approval.
Do we have a second?
Chris
Second,
Burke,
Mike Shaw.
second.
We'll take Heather. Let's take Chris's second on that, and then you want to do your roll call vote.
Okay. Jason Fairbush,
Aye.
Brent Bryant,
Aye.
Matt Boggs,
Aye.
Chris Burke,
Aye.
Jack Murphy, Jesse Brown, Lamar Hammond,
Aye.
Steve Lawley,
Aye.
Mike Shaw.
Aye.
Motion passes.
Welcome
Right.
aboard, Steve.
Thank you.
Yes.
Good to be aboard.
Welcome. I guess before we move on, I didn't know if there's any other comments from the committee about Mr. Lawley's appointment, or any other warm regards for joining us. We really do appreciate you, Steve. I've appreciated working with you along the years, and I got to tell you, Steve was one of the first people I met, and one of the first people that helped me get a lay of the land of transit, especially on the legislative side of things, and always appreciate that.
Well, thank you. It's good to be here, though. There's some great people, just admitting that, so it's still very close to me. Still writing a column commenting on it, so.
Okay, well, if no other comments from committee members, we're going to move to item 4 on our agenda, which is receive the investment reports for the period July 1st, 2020 through September 30th, 2020, which of course would be the third quarter of our previous calendar year. And then because we did not have a fall meeting, if you will, we also have receive investment reports for October 1st, 2020 through December 31st, 2020. And I know we have our experts from BOK, Bank of Oklahoma, on the meeting with us today. And I would suspect, are we going to, I know we usually have a pretty detailed analysis and run through of the reports. Will you just be covering, as far as detail goes, the most current report? Or
that, unless you all have a different preference, that would be my recommendation. Would be, because I'll talk from the fourth quarter book. Well, here, let's do this. I will cover the portfolio specific information from the third quarter book for the record.
okay,
And then the fourth quarter book we'll use to talk about the whole 2020 year calendar
Okay.
year in review. That would be my recommendation.
Unmute
great.
button. Mute button. Button. Mute button. You are unmuted. Jack Murphy.
Yes.
Computer audio unmuted, video off. Application.
Yes.
Hi,
Me.
Jack.
Hi.
Hi, Mr. Murphy. You have joined.
Am I
You've joined the
coming
committee
through?
meeting.
Yes.
Welcome. Heather,
Video
may
off.
you have the record reflect at 1:46 committee member
List.
Jack Murphy joined us?
Me.
Yes, I will.
Computer audio unmuted, video off. Application.
All right. So Mr. Sweeney, thanks a lot for that recommendation and that approach. I think that sounds like that should work. If you want to go ahead and provide your report review, we are ready.
Okay. In the third quarter, the 3Q 2020 review book that we provided, which I think is the one, yeah, that's the one that's up on the screen right now. If you want to flip to page 26, we'll start on 26. So on page 26, we'll show the current, or the asset allocation of the portfolio as of September 30th, 2020. Just for point of information, the portfolio market value on 9/30 was $14,869,000 and some change. The equity was at 60% of the portfolio, which is about 5 points over long-term target. That's a purposeful overweight that we had on at the time. And that represented about an $800,000 overweight to equity in the portfolio. So in the next page, on page 27,
Microsoft Edge window. Lisa K. Hubble's personal meeting room.
total portfolio performance for the third quarter, so the July 1st to September 30 period, was the portfolio was up net of fees about 5.8%. That was a little bit better than the benchmark, which was up 5.4 for the period. Again, so from July 1st to 9/30, the investments added a little over $800,000 to the portfolio during that period. That's the 3-month column down there at the bottom on page 27.
Hubble's personal meeting room.
Okay.
So that's probably, I will point out, if you flip to page 41 in that same book. I will point out that as of September 30th, the expense ratio on the portfolio, that bottom of that last line, the first column in, weighted average expense ratio, the portfolio was paying about 0.34% on an annualized basis to the investment fund managers that are listed on the sheet there. The average for those peers, for the fund managers in their peer groups, the weighted average would be about 0.94. So you all are about a little over 0.5% cheaper than the peer group weighted average if we had used the average cost fund from each of those peer groups instead of the ones that we do use. So that's a positive thing, and 0.5% over the long term is a particularly material amount of money. So that's a good place to be. 2 pages down on page 43, and this will be the last thing I cover for third quarter. Page 43, we had no managers on watch, so there were no recommended changes to come from. At the time, we were comfortable with the overweight to equity in the portfolio and the underweight to fixed income and cash to pay for that. And there's no compliance issues, no managers on watch from the third quarter. So that was the third quarter report. And if you all, I don't know, do you need to, Jason, do you need to take these separately and receive them separately as action items?
No, we'll vote to receive the reports together.
Okay, so we can go to the fourth quarter report unless anybody has any questions, and please interrupt me if you all have questions.
Not hearing anything from the committee. I think we're ready to go to the next one.
All right, the fourth quarter book. So 4Q, it's probably the item right above that one you just clicked on. Yep, that one. Yep. So if we go to the page, I think 3, page 4 here, I'll talk a little bit about 2020 and a little bit about 2021. I'm not going to take up too much time here. Both stories are pretty much the same, whether we're talking about 2020 and backward looking, or we're talking about 2021, 2022 and forward looking picture. It's both of them, the conditions that exist both in the last year and what we expect going forward are pretty consistent in terms of what will drive portfolio performance. In the way that we're kind of talking about this right now is we think of it, the analogy we use is a 3-legged stool. So portfolio performance, backward looking and forward looking, is kind of the seat of the stool, and what's supporting that seat of the stool is 3 things. One would be COVID and the vaccine. So 2020 was obviously impacted significantly, particularly early in the year, by COVID. The economic impacts are significant, but we don't think they're permanent at this point because the time that it took to get a vaccine created and the time that it will take to get it distributed globally will be unprecedentedly quickly. So the permanent impacts should be minimal to 0 in terms of economic losses due to COVID. And what I mean by permanent losses is the impact that it will have, say, 20, 30, 40 years from now on investment returns, on incomes earned, those kinds of things. There is some discussion about education and the missing in-person classroom for kids around the world. And right now, that's still there's hypothesis on both sides that having them out of in-person education and in-person contact with teachers is going to have a long-term material impact on income earned for those kids as they grow up. There's also a hypothesis from another camp that says that we can overcome that through education over the next couple of decades or next 15 years or so as those kids kind of matriculate through the system. So again, COVID obviously had an impact on financial markets, had short-term impacts on the economy. We recovered. We had an exceptional year. The second leg of the stool would be the fiscal policy picture. So fiscal policy, that's the things that we talk about with the federal government and state governments and how they spend money, how they raise revenue through taxes, those kinds of things. the position, the fiscal policy position that we've been in over the last year, roughly, and what we expect going forward is what we would call accommodative. So it's supportive of growth. At this point right now, we don't believe that the government is in a position to push through changes to tax policy, to regulatory authority, to the kinds of things that will be detrimental to long-term growth economically or harm financial markets. It is a picture we obviously keep a continuous eye on, and we continue to watch. But at this point, the federal government has been very supportive, obviously, with stimulus, and we actually just got another package this week. It's going through Congress and going to the president's desk for signature that will be supportive of state governments and particularly, and of a big chunk of the population with stimulus checks. So that's the second leg. That's that federal government, state government support for economic growth and the local economy. The third leg of the stool would be the Federal Reserve. That's monetary policy. So that's interest rates, that's money supply. Right now, the Federal Reserve, which is the group that controls that overnight lending rate we've talked about in the past, the rate at which banks borrow money from each other overnight, that overnight lending rate is 0.25% to zero. It's effectively 0% right now. That rate is expected to stay low for quite some time. That rate does have an impact on longer term rates across the maturity spectrum. As long as the Federal Reserve keeps that rate pretty low, it should be a good stimulus to borrowers to borrow money for expansion of their businesses, through the banking system, through mortgages. The housing market has obviously been a highlight the last year. You all are probably familiar with, even in places that didn't see quite the negative impact of COVID, places like Oklahoma City that was experienced in New York City or California and those kind of places. We still had a very hot and still have a very hot housing market in Oklahoma City in our local market. So, and we expect that trend to continue for a little while on that side. Again, monetary policy, we expect that interest rate to stay low for some time, probably through 2023 or into 2023, so over at least another year and a half, 2 years. I would say there's been some discussion about inflation risk. And I think some of the inflation risk with all of the borrowing that's happening by the government, the low interest rates that are in place with the Federal Reserve, and the money supply growth that is being driven by the Federal Reserve. So that's what generally causes inflation. As the supply of money out there grows, it puts money in people's pockets, and it creates demand for them to buy things. That would be the idea. And then that demand for goods and services drives inflation. That would be the theory. The piece of the puzzle that's missing from that analysis is that in addition to the money supply growth, just the cash that's out there in the system, and we'll look at a chart in a second where we can see the money sitting out there in the system and the growth rate of that. You also need something called the velocity of money to happen and to grow. And the velocity of money is the speed at which cash flows through the economy, the rate at which it's spent consuming those goods and services that are produced by the participants in the economy, which is you and me and everybody else. So both whether you're looking here in the US or globally, we're all participants in the economy in one way or another. And so if we're sitting on cash, which we'll look at a chart in a second on this, if we're sitting on that cash and not spending it, then the velocity of money is very low. And if the velocity of money is very low, inflation is not really the risk. Deflation becomes the risk. And that is something the Federal Reserve and central banks around the world absolutely want to avoid at all costs, because deflationary spirals are notoriously hard to get out of, to break. If you're a consumer and you're sitting there and you're thinking, you know what, I might want to go buy a loaf of bread today, but tomorrow that loaf of bread is going to be 5 cents cheaper, I'm going to wait and buy it tomorrow. And that's deflation, right? As prices fall. And the more we put off making those purchasing decisions, the faster and farther that deflationary cycle that spiral will go. And we kind of get caught in this rut, this loop, endless loop of, well, if I waited today, I can wait tomorrow. And if I waited one day to buy that loaf of bread, to get the 5 cent cheaper price. I'll wait tomorrow to the next day now, and I'll get it even 5 cents cheaper. And then that kind of goes on and on and on and on. And we put off particularly big purchases, waiting for cheaper prices to come, and they never come. I mean, they continue to come, but our expectation is that they will continue to come. And then, so that spiral is really hard for policymakers to break. And so what they want to do is avoid deflation. And so with that little bit of kind of education, we'll move on and go to, I'm going to flip ahead to slide 19. Actually, let's go to 18. In between where we were and slide 18, there's some charts in there if you all want to look on statistics on COVID, on economic growth, on the growth of central bank balance sheets, and inflation and unemployment, all the stimulus packages we saw last year. There's some information in there if you want to do that. But I'm gonna skip ahead and kind of finish this story and then move to the portfolio in the interest of time. And please, again, if you all have any questions or comments, just interrupt me. Feel free, please. But on page 18, the personal savings rate. This is a chart of personal savings rate, and this goes to the comment that I made just a moment ago about cash in the system, right? So what happened was, or what generally happens is American wage earners, that's all of us working, we typically save about 8 to 9% of our periodic income, our paychecks, right? Whether that's in retirement accounts or checking and savings accounts, CDs, whatever it is that we might consider, it's all that money that we don't consume in the period on goods and services. And that savings rate, you can see, to use the title here, it exploded in 2020. What we saw was basically when the economy shut down early in 2020, we didn't have any place to spend our money. And there was a little bit of fear mixed in there that I need to hold on to some cash in case for whatever comes over the next few months. And so the savings rate jumped to almost 35, 36% early in 2020. Now that number's come down. It's sitting right now just under 15%. So we're still saving nearly double what we normally would each of our paychecks. But that we hope to see that number continue to come down and get closer again to that 7-8% range where it typically is for the U.S. Now, looking forward into 2021 and 2022, we do expect that number will fall, and as people consume more and travel and start to recover some of the normal pattern of spending that they've had over the last number of years. But then you ask, okay, if they're saving so much money, where is that going? And if you flip to page 19, you can see where the cash went in 2020. And on page 19, you can see there was a $3.5, almost $4 trillion increase in the amount of cash that's sitting in savings and checking accounts across all of the banks in the United States. That's what that chart shows there, is the amount of cash sitting on the sideline in the bank deposits. And with that big jump in 2020 on the right-hand side of that chart, that's just cash that's sitting on the sidelines waiting to be spent. And so our optimism, which this is all the way to say what we saw in 2020 and what we expect in 2021 and 2022 is a continued optimism and economic recovery, growth, and financial market growth. It's really driven by this chart right here, what we're showing here, and it's all this cash sitting on the sideline. And as it gets back into the economy and starts to get consumed, we think that'll be really good for businesses and then obviously the investments in the portfolio as their profitability starts to climb up. So that's really about it for the outlook and the look back on 2020 and then the outlook looking forward. If you want to flip to page 20, just a quick story. I like this chart on page 20 just because you can see the bottom chart there is the chart for a 30-year mortgage rate. That chart shows that during 2020, mortgage rates for 30-year mortgages fell below 3%. I think they just recently ticked back up above 3%, but I've seen 15-year mortgages get quoted below 2%. fixed rate mortgages. So this is what was really driving that housing market, as we talked about before. So that's the economic and market outlook stuff. If you want to flip to, if there's no questions, we'll move ahead and flip to page 38. Okay. So on page 38, the ending market value for the portfolio was a little over $16.5 million. You saw before in the last deck, the 9/30 value was a little over 14.8 million. So we added quite a bit in the fourth quarter alone, and we'll look at the performance piece in a second. But the allocation picture that we're showing here, you can see the 60% equity is now at 62.4. I don't have a recommendation today to make a change because we still are optimistic about the equity markets, particularly more favorable to equity than we are to the bond side. So I don't have a recommendation to make any change now. Again, because the conditions that existed in 2020 are the same conditions we're looking at in 2021. And as COVID cases come down and the vaccine gets distributed and this becomes less of a critical issue for us, we think economic growth will improve, markets will react positively to that. So we like being overweight equity at this point. We will keep an eye on it relative to your investment policy statement to make sure that we're in compliance there. Actually, we're overweight. We're over compliant. I will have to make a recommendation when you all meet next. Now that I look at page 37, I apologize. So with that said, I'll come back with a recommendation at the next meeting, just FYI. But if you flip to page 39, you can see the fourth quarter, which I talked about. We added $1.6 million in investment returns to the portfolio. That's the first column in that table on the bottom. The investment gain loss, third line down. 1.6 million was added in the fourth quarter. It was a 10.6% return after fees. The benchmark was up 9.7, so we had a pretty good fourth quarter. And if you look at 2 columns over, the 1-year number, the net of fee return was 12.7%. So after you paid BOK fees and the investment manager fees to the fund managers, the return was 12.7. The benchmark was up 14, so we were a little behind. But 12.7% return is pretty good. So for particularly with the year we had. So that's the performance. I don't have allocation recommendations today, but I will because we just talked about that. And so if you want to flip to page 56, the last thing that I have, oh, that's too far. It's a different report. So on page 56, just it's a kind of a no story here. There's no managers on watch, nothing to worry about or as an issue for compliance in terms of manager due diligence. So there's no changes from that perspective that need to be made at this point. And with that, I will take questions, but that wraps my report.
Yeah. Hey, Mr. Sweeney. Yeah, I just wanted to revisit. Well, I guess it's page. Let me get here again. I don't know if we have to go to it, but on page 38, you had discussed or you had shown where our equities are 62.4% of our portfolio allocation, which I think is like 2.4% over like our maximum range, which I mean, I understand that's minimal and that's probably fine. But I just want to make sure the committee understood that we're going to be going, I guess, the next quarter being a little bit overweight compared to our policy if we don't make a change today. And I'm sure that we've encountered this before, but it's just been so long since we met and looked at these numbers. I just wanted to make sure the committee was aware of that and there weren't any objections to just bringing back some recommendations at our next meeting, or something needed to happen before that.
And I'm happy to make a recommendation in between meetings. I just don't know
Yeah.
the protocols that you all have for
Yeah.
doing that. That's why I said next meeting I can do it.
Yeah, exactly. And it's no criticism at all. I'm just from a point of process. And I guess I am throwing that out to the committee then is like, are we okay with addressing the overweight that's kind of above our range next meeting? Or is there something we want to ask Mr. Sweeney to look at and consider in the interim?
Jason, I know we also have our actuaries that'll be reporting shortly, and perhaps in after we hear from them, we may have several. We may have more action items to consider that we may have to do a short special meeting on if we don't have the ability to take that action in this meeting.
Hey, Jason, this is Brent.
Yep. Yep.
We had an ERS meeting today. We did the kind of this exactly what we had an issue there. We talked about it we meet monthly, not quarterly like we do on ERS, but bottom line is we actually increased our top end on our equities today. So I think that's kind of with the way things are going. We still want to have a balanced and blended portfolio for long-term sustainability, but to me, it'd be great if Michael could come back with a recommendation, and I kind of like what Mike says, just have a special meeting to approve that, because I don't think we have latitude to having changed that today. I think that's an actual policy we'd have to bring back. So I'd recommend that we come back, 2 or 3 weeks from now, or 2 weeks from now, and have a really short meeting and get it done, so he can make the adjustments and we're within compliance.
Okay. All right. So, so hearing from Mr. Bryan, are there any other discussion from committee members? And otherwise, we will proceed with that recommendation. Okay. All right. Okay. So we'll look at a date for a special meeting, and then Mr. Sweeney will give you that should give you plenty of time to come up with a recommendation. And again, like Mr. Bryant had said, ought to be a really quick meeting. So I guess where we're at now then, item 4, asking to get a motion to accept the 2 financial reports that were provided to us today.
Mike Shaw, so moved.
Jesse Brown, second.
All right, Heather, can you take roll call? And also please note, Mr. Brown is in attendance today. And Jesse, I'm sorry I didn't see the exact time you joined, but we'll definitely document it for the record. Do you have about a time where you joined the meeting?
Yeah, it was probably about 10 minutes ago.
Okay. All right. Heather, can you take a roll call?
Yes, sir.
Vote. All right.
Jason Fairbrush,
Aye.
Brett Bryant,
Yes.
Matt Boggs,
Aye.
Chris Burke,
Aye.
Jack Murphy, Jesse Brown,
Aye.
Lamar Hammond,
Aye.
Steve Lally,
Aye.
Mike Shaw,
Aye.
I'm not sure if we've lost Mr. Murphy. I can't seem to find him.
I'm looking at our participants. It would appear that we have.
Okay. All right. Motion passes.
Okay. And then item 5 is discuss any changes to our asset allocation or fund managers based on investment advisor recommendations. And I know we didn't have any fund managers on watch, and it doesn't look like we have any changes today to our asset allocation either. Is that correct, Mr. Sweeney?
That's correct.
Okay, so no action on item 5. Item 6 takes us to receiving the actuary report as of July 1st, 2020. And I believe we have Ms. Packer from USI, familiar face to this committee. Usually we get to see you in person, Jamie, but welcome.
Hello, I hope everybody is doing well. I'm missing my annual trip out to Oklahoma. I did ask Anthony Citarella to join today, just so he could say hi to the committee. He's really the one who does all the grunt work, but normally not accompanying me to Oklahoma, so I wanted to give him the opportunity.
All right, welcome, Anthony.
Do we have so I see the actuarial report on the screen. Do we have the presentation? I think it might be number 6, maybe. Fantastic. Okay. So I'm going to work off of this, although the report itself is a fascinating read if you have some time. Go down to the first page. We're just going to skip right ahead to developments and updates. We did have a couple new legislative items come through in 2020, and as
Jamie,
yes,
pardon me for just 1 second.
Sure.
Did everybody else, is it just my computer or is there a volume drop off?
No.
I'm just checking it. If it's mine, I can call in. So that's not a problem. I just want to make sure that everybody can hear you.
I think there is a bit of an audio issue, Jamie, on your end. It's a little bit. I think so. Yeah, you're much quieter, I think, than anybody else that is speaking. Oh wait, that's better. Wait.
Can you hear me now? No?
A little better. A little better.
I can try to call in. If you think that would be better, I can talk closer to my computer.
I'd say go for it, unless any of the committee members are having a more difficult time hearing. We'll just have to listen carefully.
All right,
As we always do.
I'll try to speak loud.
Okay.
Okay, so we've had a couple new legislation come through in 2020. And as
Jamie,
Michael,
yeah. Excuse me, I'm sorry, I was muted. What page are you on the agenda? Is it in the agenda packet?
Yeah, so we're on the USI presentation deck.
Okay.
And I think it's 3.
Yeah.
Thank you. All right.
Heather, can you advise Mr. Lawley what PDF page number it is? I believe it's 207. If you're in the PDF, page 207.
Okay. I'll check that.
Yeah, unfortunately, I can't see the PDF while I'm sharing.
Okay, I see it. It says you're on 207.
Okay. So as Michael just mentioned, that we do have a new legislation that is going to get signed by the president tomorrow. That does have some pension legislation in it called ARPA, the American Rescue Plan Act. I don't know that we will see anything that will impact this governmental plan. It looks like a lot of funding relief for ERISA single employer and multi-employer plans. But we did have 2 other acts that came about in 2020. Well, actually, the first one, the Secure Act, I think was signed into law late in 2019. It was effective January 1, 2020. And there were a couple changes in there that impacted DB plans. For your plan, though, the governmental plan, you might have seen some changes such as an increase in the minimum required distribution age. So typically when participants have separated from service and they get to a certain age, they're required to commence their benefit. And that used to be the 4/1 following age 70 and a half. The Secure Act extended that, is now the 4/1 following age 72. So participants now have the availability to defer a little bit longer. There was also a reduction in the voluntary in-service distribution age. I think it was the Pension Protection Act that lowered that from 65 down to 62, but now the Secure Act lowers that to 59 and a half. Not that you have an in-service distribution provision in this plan, but if you ever were to have one or saw any other plans, that is now allowable to age 59 and a half. In 2020, we got the CARES Act. So that was the Coronavirus Relief Act. And that came about in March of 2020. And a couple of the key changes there were sort of focused on the letting employees access their retirement funds. So such as tax relief for early withdrawals or modification to plan loan limits. So typically, if you take money out of your retirement savings plan before age 59 and a half, you have to pay a 10% penalty tax on the amount that you withdraw. So this penalty was waived during 2020 for distributions under $100,000. So you might have seen some participants be able to benefit from that. They had to be COVID eligible, which means that they were impacted by COVID, or a family member was impacted by COVID, or their job was impacted by COVID. But there may have been some individuals in your plan that could have taken advantage of that tax relief. So really, we've been swimming in legislation for the last year. I'm interested to hear more about the American Rescue Plan Act and read up on that. And in the future, we will talk about anything that might impact this plan. All right, let's go to the next slide, please. Okay, mortality update. This is something we talked about last year, but I thought it was important enough to leave it in here and sort of review it again. But the Society of Actuaries issued the first of its kind public retirement plan mortality rates, mortality tables. So in the past, the Society of Actuaries would do studies on mortality and issue tables based on experience, but they had never done a study that was just focused on public plan data. So this was the first time that they collected public plan data only to come up with mortality tables for use by public plans. So they came up with several different versions of the table. So they have versions for teachers, public safety professionals, general employees. They have a blue collar table, white collar table. So they have various versions of the table, and they're provided so that public plan sponsors and their actuaries can to assist the plan sponsors and actuaries in the setting the mortality assumption. Now we've discussed in the past with this plan, it's a very small plan. So we don't have nearly enough data to have credible mortality experience. So we have been using the tables used by the state of Oklahoma state system, OPERS, as mortality for this plan. So why would our mortality differ from the mortality for the state plan? They updated their table recently from RP 2000 to RP 2014. We did the same thing in this year's report, as you'll see in a little bit. And then I was able to pull open their 2020 report that they recently issued, and it looks like they did update to these new Pub 2010 tables. So we will likely follow suit come 2021 and also update to these Pub 2010 tables. Okay, let's go to the next page. All right, so let's take a look at the actuarial valuation results for the year. So the top line there is the market value of assets, and we can see the market value of assets increased from 13.6 million to 14.8 million. That represents an investment return of about 2.4%. And recall that the assumption that we're using in this plan is 7%. So when we see actual investment experience below the 7%, we're going to see losses. But with that said, June 30th probably wasn't the best time during 2020 to look at assets. is definitely better than March of 2020, but likely not as good as December. And if I wrote it down right, I think Michael just said the assets are up to 16.5 million. Correct me if I'm wrong, Michael, please.
Nope, you got it.
Awesome. So, so let's just take this with a grain of salt that assets did rebound from where we were as of 7/1. But those losses that I was just talking about, this is where your asset smoothing methodology comes in and goes to work. So you have a smoothing methodology that defers gains and losses over a 5-year period. So even though we're recognizing a loss on the market value of assets this year, that's going to flow through over the next 5 years. If you wanted more detail on this, you could look at page 8 of the actuarial report. But if you take a look over the last 5 years, you'll see that we have recognized losses in 4 out of those 5 years. The plan year ending 6/30/17 was the exception. We saw a gain in that year. This is going to lead us to a discussion on the return assumption a little bit later, but I don't want to jump into that just yet. The asset growth was also helped by employer contributions. So if we look at last year's actuarial report, the recommended employer contribution was 428,000, but we saw actual employer deposits of 683,000. So that differential helps to bridge the gap between assets and liabilities. So even though we saw a loss on the market value of assets, we still see an increase in the actuarial value of assets. So we're going from 13.8 up to 14.6. That represents a return of about 5.3. So still not the 7%, but not as bad as just looking at the market value basis. That's why the smoothing helps. On the liability side, we see the accrued liability increase from 17.3 million to 18.5 million. So this is an active, open, ongoing plan that is continuing with accruals. Typically, we talk about a normal cost. That's the cost of benefits accruing in the year. So we're expecting this liability to grow year over year. This year, we expected it to grow, but we had an additional increase to liability because we updated the mortality tables, and we updated these mortality tables to match what the state is using. So the state was using the RP 2000 table, which I guess in actuarial views is now outdated. So they updated to the RP 2014 table. We followed suit as we have no reason to believe that the experience for this plan would be any different than for the state plan. That update to mortality table caused the liability an increase about $500,000. So $500,000 of that increase was due to the mortality change. So you see our actuarial value of assets increases by 800,000 and our liability increases by 1.2 million. So there's a $400,000 differential there, and that differential is going to show up in that unfunded accrued liability. So if we hadn't had to make that mortality table change this year, you would have seen a decrease in the unfunded accrued liability. But because we had to update that mortality table, we see a little bit of a widening in the unfunded accrued liability. On the bottom, we present the funded ratios of the plan, so the market value over the accrued liability. And you can see that we did have a decline year over year. So on a market value basis, we went from 83.2% last year to 80.3% this year, and from 84.5 last year to 83.3 this year. Again, if we didn't have to make that mortality change, those ratios would have been higher. So on the actuarial basis, instead of looking at 83.3, we would have been looking at 85.8. And on a market value, we would have been looking at 82.7. So making the mortality change did impact plan liabilities and funded percentage. Okay, on the next slide, we show the contribution details. So you will notice a jump in the contribution this year, and really we have two reasons for that. The first is our amortization is increasing, and our amortization is increasing because our unfunded accrued liability increased by the $400,000. But the more noticeable increase is the increase in the annual employer normal costs. And as I just said, the normal cost is the cost of benefits accruing during the year. That cost goes from 165,000 up to 242,000. And really there's two reasons for this. One, is the change in the mortality table. That adds about $23,000 to that normal cost because people are now expected to draw benefits longer. But most of the difference is coming from the jump in participant count. So if you look down a couple lines, you see the participant count went from 184 to 229 participants. So we saw a sizable jump in the number of participants covered under this plan this year. So the difference is 45, but during the year we had some people retire, some people terminate, but we had 61 new actives, which I thought was a pretty large number. And I wanted to just pause there and ask if there was any insight into that large increase and whether or not you expect that to continue.
And I can comment on that, Jamie. So that's probably a combination of us bringing our Norman operation online. So we now have I guess we call it an additional division. And so that's really an entirely new work group. And then also we have done staff has done, I should say, a really good job of recruiting. We have more filled positions than we typically do. So I think those are probably the two drivers. One thing I would ask on this is when you number of active participants, is that like a snapshot of the number at the end of each of those fiscal years or?
Yes.
Okay.
So we're trying to estimate what the weekly cost per active life is. So we're dividing what we calculate as the employer contribution by the number of actives at that given point in time, knowing that it's not going to be exact, but
yeah,
unless you have a large layoff or bring a whole bunch of new people in, it should be close.
Right. Now, yeah, so just for the benefit of the committee and me too is, so if we were to have an individual that had very short-term employment hired and, even, I guess, quit or whatever within the year, it wouldn't be in those numbers. I mean, they'd have to be enrolled when you take your snapshot at that.
Yes, correct.
At the end. Okay. And then you asked if we anticipate any other large growth in employees. I mean, we are proposing on providing some service in another community that would be comparable to kind of what we did in Norman. But I mean, that's really iffy. I would just, if you're taking notes from your standpoint, maybe it's something to ask about in 6 months if it ever happened. And we'll certainly do our best to inform you of that.
Okay.
Yeah, Jamie, to follow up on Jason's, at what we're looking at right now would be about a 5% increase in total staff members. But then we also have a projection of 2 years out that would be an additional 10 to 12% increase in staff members to the COTPA side. With the BRT project when it comes online.
Okay. All right, that's good information to have. It'll definitely help us as we move forward and see the flow of lives. It was definitely something that stuck out to me this year. As when you look at the history sheet, you'll see that it's the largest number of participants that we've ever had in the plan. But it's also putting upward pressure on this normal cost figure. However, you're also spreading the cost over more people. So when you look at the employer weekly cost per active life, we actually didn't see very much of an increase at all. We went from $44.72 last year to $45.50 this year. So a slight tick up, but really close numbers. And then if we look at the negotiated amount that the employer is actually making per week, it's still at that $60.05, which is well above the $45.50. So the $60.05 wins out, and that's what is continuing to be made, along with the employee weekly cost of about $48.52, which means that the total weekly cost per active life is $108.57, which is the same as it was last year. So we did see some gains and losses, some experience change, but we end up at the same place where the contribution to the plan will be the same per person as it was last year. Okay, next slide, please. This slide just shows some of the statistics about net inflows and outflows of the plan. And we're just watching to see the money coming in versus the money coming out. We had about $1.2 million come in employee contributions, employer and employee contributions this year. About 680,000 was employer and about 540,000 was employee. Compared to benefit payments of about $1.1 million. So we have more contributions coming in than benefit payments going out. That's a good sign. We do have this administrative expense total going out of the plan too. That's about $92,000. I did ask Anthony to look at a history, a 5-year history. Anthony, I hope you're still there. What was the 5-year history of the expenses coming out of plan assets?
Yes, sir. The total for the last 5 years was about 537,000. That was total for the last 5 years.
All right, you're breaking up. I think you said 537 over the last 5 years.
Yes, that's correct.
Okay. All right. So we've got about $100,000 of administrative expenses coming out of plan assets, and that's going to pay various sources. You're using that to pay your actuaries, pay plan auditors, pay the trustee. So as we move forward, I think that we probably should look at adding an expense load assumption to our book of assumptions for valuing the pension plan liability. But I'm just going to table that for a minute because we're going to get to assumptions in a minute. And then if we look at the this is just a summary of participant count. And again, that active count is much larger than it has been in prior years. The retiree and term vested counts did not change very much year over year. Actually, I think the retiree count was 88 last year and 88 this year. And the deferred vested count may be increased by 2. Okay.
Jamie, I don't know if you recall last year, what was our average age of our plan for last year?
I don't recall, but Anthony, if you'll look that up really quick as I'm speaking, that would be helpful. He'll look that up and we'll move on. And then once he gets it, he can chime in. Yes, next slide, please. Okay, this is a review of the gains and losses, which we sort of already talked about, but we had net actuarial loss of $257,000, and that is made up of an asset loss of about $327,000. If we were looking at it on a market value basis, it would have been $635,000, but because we're allowed to defer some of that, it's less. So we have an asset loss of about $327,000. That was offset by a small liability gain of about $70,000, just due to the experience during the year. Nothing unusual going on. So we end up with a net actuarial loss of $257,000. And then on top of that, we increase the liability by the $527,000 for the new mortality assumption. But offsetting that was the contributions made to the plan that were in excess of what was recommended. So again, recommended was $428,000. In reality, we saw $683,000 come in. So that's $255,000 that goes towards reducing that increase in the mortality assumption. Okay. All right, plan history. All right, this page has a lot of numbers on it. I don't really want to focus on this page. I like to look at the charts on the next page instead, but it's there if you want to look at it. Okay, so these charts show the history of weekly contribution rates over time. And you can see that the actual negotiated employer rate has been higher than the actuarially calculated rate back through 2011, and even before that. We just are showing 10 years here.
Hey, Jamie, I'm sorry. Heather, can you zoom that? Can you hit the zoom button at least once on that? That's pretty small for most of us. There, hit it twice, even better. Okay, thank you. Sorry for the interruption, Jamie.
No, that's fine. And so you can see that in 2017, from 2017 to 2018, we see an increase there. And that really coincided with an increase to the benefit formula. So the benefit formula was increased to $60 that year. And the employer contribution went from 5504 up to 6005, and the employee contribution also increased to 4852 that year. So over the last 10 years, we're looking at, we've had one rate increase, and that was effective for the 7/1/2018 plan year. And then you can see in the red line, that's where we show our recommended contribution. And that jumps around based on the normal cost, based on gains and losses, the unfunded amount. But consistently, it's been below what has actually been going in to fund the plan. Okay, next slide. And then this is a history of the funded ratio of the plan. So, I mean, it is slight, but you can still see an upward trend there. Back in 2011, the funded ratio was about 72% on a market value basis. And as of today, we're up to 80%. And if we valued it using those 1231 assets, we would be higher than the 80%. So what I like to look at is the patterns, and what it looks like is going on here is you're at 70%, you fund up, you experience some gains for a while, or the additional amounts going in over the recommended, that is helping bridge that gap. You get to about 80%, and then we see a benefit increase in the formula, and then that dropped it down to 70 something percent. Then again, it takes a couple years and it ramps back up to 80%, and then we have a benefit change. But since that last benefit change, we have stayed pretty level around the 80% mark. So I think that is good news. We haven't seen any drop off. And I think with these most recent assets, that's good news. Although we don't know what is going to happen before the end of the year, but knock on wood. Okay, next slide. All right, Anthony, do you have that number before we go into the review of the plan assumptions?
Yes, I think you asked this year the range was about 51.9. Last year it was 51.6.
51.9 versus 51.6.
Yes.
So not much movement.
Thank you, Anthony.
Okay, so the review of the assumptions. So the assumptions are extremely important to how we value the plan liability. They really are our toolbox to be able to value this plan liability. And there's various assumptions, and we need to make sure, based on our actuarial standards, but also to best service our clients, that the assumptions are our best guess of what is going to happen in the future. And in order to make sure that we are making those assumptions equal to our best guess, we do recommend looking at experience analysis from time to time. A good rule of thumb is about 5 years. I believe the state of Oklahoma does an experience study once every 5 years. The last experience study for this plan was 5 years ago. Well, actually, we're coming up on the 6th year. So I do recommend looking at the assumptions. I think the assumptions we're going to want to look at. So we have 6 major assumptions in this plan. We've got mortality, discount rate, retirement age, withdrawal, disability, and expense load. So mortality, we don't need to look at. We know that we're going to update to what the state's using. Even if we analyze mortality on this plan, it's not credible. The population's too small. So there's no need to even look at it. We know we're going to use what the state table is. We did run those new tables against the data, and they actually reduce your liability slightly. So they reduce your liability by about 1%, which would be about $200,000 on today's liability. So when we adopt those next year, we'll see a little bit of a gain. The discount rate, this is what we were talking about earlier with Michael. So our discount rate for valuing liabilities, we want that to be equal to the long-term expected rate of return on plan assets. And I know that we've had the discussion in the past that we think 7% is aggressive. I think we need to look to lower that rate. And I think, Michael didn't have recommendations today, but I think that he was probably waiting for us to have this conversation to see where you wanted to go from here. But when we look at the discount rate, we can look at past returns, but we can't just live in the past. We also have to look at the future capital market assumptions and make a guess as to where we think rates are going to go. So, yeah.
Jamie, if I could ask you a question, have you done any sensitivity where you change the discount rate to like a 675 or something like that, and see what the liability is and what knows it? Does it move us down 5 basis?
Yeah, you're jumping ahead. Yeah.
I'm sorry.
No, I think it's on the next slide or the slide after that.
Okay.
Oh, yes, we have it.
Okay.
Good question.
Sorry.
I would have asked the same thing. So that's why we knew that it was going to be an important question. The retirement age. So really, I think the assumptions we need to look at are the discount rate, but that wouldn't be part of a study. We're talking about that now, and maybe Michael has to go back and do some work for you to get comfortable with whatever our new assumption is going to be. But I think we should take a look at retirement age, withdrawal disability, and expense load. And if you recall, last time we did an experience study, we did change the retirement age assumption, but we did not change the withdrawal or disability assumptions. And at the time, the thought was that we were seeing more terminations than we were expecting, but the thought was that there was going to be a program to prevent people from leaving, to retain employees. So we didn't want to jump the gun and implement a reduction to our withdrawal assumption, or an increase to our withdrawal assumption, I'm sorry. And for disability, I think the same thing was true. If I recall, there were new disability requirements by the state. So we didn't know how that was going to impact things. So again, we didn't want to make an assumption change without accurate experience. But I do think it is time. It's been 5 years, almost 6 years now, since we've looked at these assumptions. And I think we need to look at them individually and come back to the table with some recommendations on either, yes, we're good, or we need to adjust this. I think the expense load is an important one. We've never really had an expense load before, but the $60.05 has more than covered the recommended. So even if we had added an expense load before, it was being covered by that contribution requirement. But when we start talking about dropping the discount rate, maybe we get into a situation where it wouldn't be covered, and then we'll start seeing losses every year as expenses are paid out of plan assets.
Hey, Jamie, question for you on the expense load.
Sure.
Those expenses associated with the plan, like legal services and audit services, do they have to be funded by the plan? If there was another funding source, then we wouldn't have to do we wouldn't
Correct.
necessarily be considering an expense load.
Correct.
Okay.
They have to be paid, obviously, but they don't have to be paid from plan.
Yeah, no. Since we have the finance director on with us and the city treasurer, we always pay our bills. We have different funding sources for paying bills. Okay, just had to say that. Thanks, Jamie.
And I think Michael and I were having a discussion where, when we start talking about the discount rate, the return on assets, that could be net of investment expenses. But really, when we start talking about administrative expenses, that would be very difficult to get a discount rate that was going to provide enough return to cover those administrative expenses. So we're thinking we should have an explicit load for it as part of the actuarial assumptions.
Okay.
Unless you tell me that you're going to pay the fees elsewhere.
I have a question, Jamie.
Sure.
The retirement age, why do those numbers not reflect what our plan is?
So the plan provisions are one thing. So you can go out at 65 with 5 years. or after 25 years of service. But the provisions reflect, or the assumptions reflect what we think is going to happen. So we don't necessarily think that people are going to go out, at least based on our last analysis, that people are going to go out with 65 in 5 years. They're more likely waiting another couple years to go out. And the 60 with 30, so we saw that people weren't necessarily going out after 25 years of service. They were waiting another couple years before they retired. So the provisions are what the plan document actually says, but the assumptions are what we think is going to happen.
Okay, thank you for that. That makes sense.
You're welcome. Okay, let's go to the next slide. This is some more discount rate analysis, but I feel like I'm gonna toss most of this over to Michael because he is much more knowledgeable about it than I am. But I just wanted to show some data about the actual return over the last 5 years. And every time we're not hitting that 7%, it's causing losses to the plan. But again, maybe it hasn't been so noticeable because you've been overfunding. You've been putting in 60 instead of 45 or 50 or whatever the number that we've been giving you is. So you've had those extra funds to sort of make up any market losses. But as the recommended contribution gets closer to the 60.5 or the 60.05, it's going to become more apparent when we do have losses that the differential is not going to make up for it. So I looked at a 5-year arithmetic mean and I came out close to 5.4%. If we go to the next slide, I have a little bit of a analysis here based on some long-term rates of return and the target allocation that also gets us close to 5.4%. This isn't nearly as sophisticated as anything that Michael can do. So again, I think that you probably want his recommendation and thoughts on this. My thought as the actuary is that the 7% is very aggressive and I think we need to lower it. Let's go to the next slide, please. Okay, and here's the analysis. So what happens if we take the 7% and we lower to 6.5, and then I even showed 6%. Obviously there's points in between 675 and 625. And if you wanted to see any one of those, I can absolutely get that information for you. So you see here, if we changed the discount rate to 650, our accrued liability goes from 18.5 million up to 19.4 million. And the funded ratio would go from 80.3 down to 76.5. If we went all the way to 6, which is a 100 basis point movement, and I'm not suggesting that's right, I'm just wanted to show the impact. We go from 18.5 million up to 20.4 million, and the funded ratio would drop to 70, almost 73%. All right, let's look at the contribution requirements on the next slide. Okay, so right now under the 7%, the weekly recommended per employer cost is $45.50, which is under the 60.05. If we move to 6.5%, we'd be looking at $55.77, which is still under the $60.05. But again, the differential is much smaller now. If we moved all the way to 6%, it would jump up to 66.58, which would be above the $60.05. So we would need an additional, $6+ to come from somewhere in order to be able to meet the actuarially determined contribution for the year.
So Jamie, if I could, so could we look at it where the employer contribution with year end is 542 as of it is right now with 7%. It's going to go up another $120,000 if we change our assumption to 6.5, or if we go down to 6, it increases it $500 or $250,000 roughly from the 792. Okay, so that would be the cost to the system, the cost to the city and providing the assistance to COTPA to provide these benefits. Is that right?
I don't know necessarily, because isn't the cost to the city the $60.05 per participant? So like under
About $78,000, Jamie, if we went to 6%.
What was that again, Mike?
Yes, okay.
It's right at $78,000 if we go to 6%. The cost for us, because it'll be the 653 times 52 weeks times 229 participants.
Yeah, because if you went to 6.5, we're saying that our calculated cost would still be below what you're putting in, so you would be okay. You would just still put in what you're putting in.
Yep.
But if we went all the way to 6, it would be above what you're currently putting in, so there would be a makeup cost.
Has this board ever considered like go to a 675 with the intent to get to 650 in 5 more years, or do you think it's to actually go down 50 basis points?
I think we need to agree on an assumption that we think is reasonable. I have seen phased approaches, but with that said, I think that if we were going to use a phased approach somewhere in the valuation report, we would still have to caveat that, let's say next year we use 675, but we really thought that 650 was the right answer.
Okay, all right.
We'd have to disclose that.
Okay, I see what you're saying.
I think that might have been my last slide. There might have been one more. Okay, okay, this is the slide on mortality. We sort of already covered this, that next year we'll update to that OPERS table, the pub 2010 table, and that will decrease plan liabilities about 1%. So I think it is important to when we're talking about assumptions, it's important to talk about them individually. Do we individually think that they're the right assumption? But it's also good to talk about them in aggregate, because we're talking about making an assumption change to the discount rate, which was going to increase liabilities. But here with the mortality, we see, well, we're going to save a little bit on the mortality. So what happens if we look at retirement and withdrawal and disability? How might we make changes to those assumptions that could potentially offset a change to the discount rate? Now, I'm not saying it will. We'd have to look at the experience, but it might.
Okay. Yeah, I think most of us on this committee remember when we looked at these assumptions, like you said, several years ago, and there was kind of some give and take on the funding ratio. So I think, no, this is, I mean, obviously, certainly helpful information. We always look forward to your annual report, Jamie. Appreciate your diligence and really kind of helping us think through all the things we ought to be looking at. It's a good reminder for us once a year, because, a lot of times in these meetings, we're paying bills and we're looking at our investment reports, so this is really helpful. I think obviously, I think the next step here, and I'll definitely confer with the vice chair, is probably either in the potential special meeting we talked about, or maybe the next regular meeting, we open up for discussion what our next steps are, I think, on looking at the assumptions, including the discount rate.
Jason, is this something we would want to maybe do before the end of the fiscal year, so we would have it nailed down and can plan for the next, if we're going to have to provide additional funding to make it all happen, or do you want to try to do it in the middle of next fiscal year?
Yeah, I mean, I think, obviously I would defer to the committee on that, but I don't know. Does the committee have any preferences? I mean, we could try to fast track this and have a special meeting and try to come up with a decision. I mean, I do think this is like the second or third year now that we've heard Jamie's recommendations and kind of some concerns or warnings about our discount rate. So I do think there's some risk definitely for us for having yet another actuarial report with a notation that, you know, our discount rate needs to be looked at. So I guess what I'm saying is we definitely, I think, probably need to decide if we're going to make changes before the next annual report comes out, certainly, and have those assumptions built in.
Well, I would just like to say, from my perspective, knowing that you have assumptions that need to be adjusted and living by, oh, we're 80% funded at these really not great assumptions, I would rather have a 75% funded program with really good concrete assumptions. To me, that's a better way of doing things. That's just my own opinion, but that's just the thing that I've kind of been taught over the last 2 years in this role. So
yeah, no,
I just like to pass that on. I sleep much better, and it helps me explain that to Standard & Poor's and Moody's when we're doing rating presentations, that we're not being we're being very diligent with, you know, relying on our actuary, that we have good solid assumptions based on real data and, you know, based on the trends and all that stuff to help. I think that's I would highly recommend if we could do that. So
okay, well, let's do this then. And what we could, Haley, we have you on the phone, Haley or Heather. Like if we wanted to have a special meeting, I mean, I guess, could we do that under new business? Could Mr. Bryant make a motion to recommend a special meeting to discuss the assumptions? I mean, if we want it for the record.
Haley, can you hear?
Yeah.
Yes, in new business, yes, that can definitely be recommended, and then we can schedule that.
Okay. So that's an option. Brent, if you want to make a motion for the committee to go ahead and establish, hey, we're going to do a special meeting, try to get these things vetted, kind of fast tracked. And I think I'm also hearing, like, if there is going to be a liability there, or basically if it's going to take more money, we better to know about it earlier rather than later.
Right. I would like to be able to plan for if we need to increase our subsidy, we increase our subsidy.
Yep.
We had to do that for the employee retirement system.
Okay.
Because we adjusted our assumptions last year. So.
Okay.
If I may,
all right, Jamie, go ahead. Yep.
I'm sorry,
Haley?
It wouldn't be a motion or anything. It would just be a conversation and allow all of the members to voice their input on if they would like to have that special meeting as well.
Okay. All right. Jamie, thank you, Haley. Jamie, do you have anything else for us?
Nope. The only thing that I would add is that I do think that it would be important to have the conversation and make assumption changes prior to issuing the next report. But with that said, we normally don't issue the actuarial report, I would say, until October timeframe. So yes, the fiscal year is going to end on 6/30, but I think you have a little bit of time after that as well.
Okay. Yeah. That's helpful.
So when we had if we're going to have a special meeting, it sounds like we have two items of possible discussion, which is the discount rate and the recommendation from our financial advisor on any change to the plans. I just want to make sure I make note of that so that as this committee has that conversation, my personal recommendation would be that we include Jamie and of course Michael on those calls on any special meeting as an advisor.
And hey Mike, I don't know if you're like literally taking notes. I think it's really, if we end up having a special meeting, I think it's more to discuss the plan assumptions in their entirety rather than just the discount rate.
Discount rate. Yep. Thank you.
All right. Well, with that, I'll take a motion to receive the actuary report as of July 1st, 2020. And thanks again, Jamie,
No problem.
and Anthony for all your work. Appreciate it.
I'll make
Absolutely.
a motion to receive the report.
Okay, do we have a second?
I heard 2 seconds. We're gonna sit Steve Lally for the second.
Okay, Heather,
Second.
roll call, please.
Okay.
Okay, Jason Fairbrush,
Aye.
Brent Bryant,
Aye.
Matt Boggs,
Aye.
Chris Burke,
Aye.
Jack Murphy, Jesse Brown,
Oh, you'll have to take Jesse off mute, Heather.
give me 1 sec. Oh, that was him, huh? I can't seem to find him.
He's the 405-414-1386 number.
There he is. I can't seem to unmute him. I think he needs to unmute himself.
Yeah, I just sent him a request to unmute. Well, let me ask you this. Do we have enough votes for, I mean, if he dropped off, we still have quorum. Do we have enough
Aye.
votes? Oh, there he is.
There he is.
Thank you. Okay,
You're
so
welcome.
Lamar Hammond,
Aye.
Steve Lally,
Aye.
and Mike Shaw.
Aye.
Okay, motion passes.
All right, item number 7, receive GASB 67 and 68 statements as of June 30th. And I know that we are running over on time, and I know other people have meetings, so I'm just going to do a time check here. Did you have a presentation, lengthy presentation for this one, Jamie?
No, I don't normally talk through the
Okay.
GASB report.
Okay.
Unless you tell me it's super important to you,
Okay.
then I normally focus on funding.
Yep. Okay, just for the committee's benefit, would you just
Sure.
summarize what we're receiving here, and then we'll
Sure.
take a motion.
So really, we have two reports for the year. We have the funding report, which is the cash that needs to go into the plan. And then we have the accounting report, which is the plan financials for the year. So this is under GASB 67 and 68. And this was for the fiscal year ending June 30th, 2020. If you scroll down, I want to say it's page 3. Let's see. Yeah, stop there. Thank you. All right, so this is the schedule of changes to the net pension liability. So really, GASB just has fancy words for what we just looked at. So the total pension liability is your accrued liability. The planned fiduciary net position is your assets. So we're really looking at your assets compared to your liabilities. Your net pension liability is the amount of your liability minus your assets. So you can see it's 4.5 million compared to 3.7 million last year. Most of that increase is due to that change of assumption. So the same mortality change we made to the funding report, we made that to the GASB report as well. And the next several pages are just schedules of required supplementary information. So if you just scroll down to the next page, you'll see the assets. One more page, please. Yeah, so here we go. It's your actuarially determined contribution for the year compared to what was actually made during the year. And you can see in every year you've had an excess there, and that's because you're putting in the 6005 instead of whatever the number is that we calculate. And then if you scroll down further, there's a lot of supplementary information here. So if you keep going down, so there's information about the cost method and description of the plan and plan administration and the plan provisions. There's asset information in here and sensitivity information. I would say that to get the plan discount rate for GASB, you have to run out a 100-year projection to make sure that your future contributions are going to be able to cover all benefit payments. And we have done that, and we have proven that, yes, future contributions are going to be enough to cover future benefit payments. So that's why we're still using the 7%. But a change to that asset return assumption would also change the assumption for this purpose as well. So assumption changes would affect the funding report and the GASB report. And then if you scroll down to the last page, I think maybe it's the second to last page. The second to last page is the pension expense for the year. Let's see, one more right here. So that's the pension expense for the year, and it's really, this is not a cash number, it's really an accounting number. And it was calculated just at about $300,000 this year. So GASB has rules about how you have to amortize gains and losses. So asset gains and losses are amortized over 5 years, whereas assumption changes and experience gains and losses are amortized over the average future service lives of the plan. So that's the GASB report. There's no cash implications here, but this is used to roll up into the financial accounting reports.
This is Amy from accounting, and that's what I was going to say, Jason, to tell the board. We're actually required by GASB to put all of these disclosures into the audited financial report. So we basically take this report and copy it into you guys' financials. So they'll see all this same information. That's why they have to do the separate report.
All righty. Thank you for adding that to the discussion, Amy. Appreciate you being here today. All right, can we get a motion to receive GASB 67 and 68 for June 30th, 2020?
Motion. Jesse Brown.
Thank you, Jesse.
Second, Brent Bryant.
Heather, let's go. Let's do it.
Okay, Jason Fairbrush,
Aye.
Brent Bryant,
Aye.
Matt Boggs,
Aye.
Chris Burke,
Aye.
Jack Murphy, Jesse Brown,
Aye.
Lamar Hammond,
Aye.
Steve Lawley,
Aye.
Mike Shaw.
Aye.
Okay, motion passes.
Item 8, ratify single sum refunds for terminated non-vested members of the COTPA pension plan. That is in your packet, and I believe there's 12 in total. So if I get a motion.
I'll make the motion, Brent Bryant.
Matt Boggs,
Jesse
second.
Brown, second.
All right, Heather, please take the roll call vote.
Okay, Jason Fairbrush,
Aye.
Brent Bryant,
Aye.
Matt Boggs,
Aye.
Chris Burke,
Aye.
Jack Murphy, Jesse Brown,
Aye.
Lamar Hammond,
Aye.
Steve Lawley,
Aye.
Mike Shaw.
Aye.
Motion passes.
All right, item 9 is ratification of application for normal retirement. We have 3 individuals on that list. One of them is here with us in person, so congratulations, Mr. Brown.
Thank you.
And Jason, on that note, on this vote, we'll ask Jesse to abstain.
All right.
Since he is a applicant for retirement and also a board member or a committee member.
Thank you for that. So we have Jesse Brown, Brenda Stepney, and Michael Richards. So could I get a motion to ratify these applications?
I'll make a motion to ratify.
Second?
I'll second.
All right,
I'm sorry,
Heather?
who made the second?
That was Brent.
Brent, okay. Okay, Jason Fairbrush,
Aye.
Brent Bryant,
Aye.
Matt Boggs,
Aye.
Chris Burke,
Aye.
Jack Murphy, Jesse Brown, oh, excuse me, Lamar Hammond,
Aye.
Steve Lawley,
Aye.
Mike Shaw,
Aye.
and then Jesse Brown, if you want to abstain.
Abstain.
Thank you. Motion passes.
All right, item 10, ratify payments to Kutak Rock for legal services provided to the COTPA pension plan for August through November. believe your packet has 4 different invoices in there, ranging from $201.50 to one of them is $3,926. And then I know the invoices contain a detail schedule there of the tasks and the hours. Mike, do you mind just kind of summarizing some of the highlights of the work that COTPA has done for us over the last few months?
Yeah, so they are getting caught up with our plan being new, and then also in the beginning of the year, in July, August, and September, October, they I asked them to do a complete plan review. I'll have them come in our next quarter meeting. Since we didn't have November, we pushed November to this month. So we were going to have them in February. In our May meeting, we'll have them present on those findings and make any recommendations to changes to the plan. And there will probably be a number of other items that they will have to address with with anything from the CARES Act to the new, I don't even remember what the new act is, but could be affecting our retirement plan as is.
And then also part of their hours billed, Mike, is just ad hoc technical support if staff
That's
has
correct.
questions on. Okay, thank you for that summary. Can I get a motion to ratify the payments?
Jesse Brown, motion.
How about a second?
Matt Boggs, second.
Oh, I think Matt, Mr. Lawley had, I think, jumped right ahead of you, if that's okay. All right, so let the record show Mr. Lawley, and then Heather, are you ready?
Yes, sir.
Okay.
Jason Fairbrush,
Aye.
Brett Bryant. Matt Boggs,
Aye.
Chris Burke,
Aye.
Jack Murphy, Jesse Brown, Lamar Hammond,
Aye.
Steve Lawley,
Aye.
Mike Shaw.
Aye.
Motion passes.
Okay, you got Brent's vote.
I'm sorry,
Heather, did you get
Brent
Brent's
Bryan,
vote?
are you there?
Yeah, Brent is on the call.
Okay.
Aye.
Aye,
Sorry, I
thank
was
you.
thinking-
Okay.
Okay. All right. And let's see. And Heather, I probably didn't acknowledge, but Heather's running all this stuff behind the scenes. She's like at her command center behind her desk. So when I'm asking her like if she's ready and stuff, I know she's not just taking votes. All right. Item 11 then is approving payment to USI Consulting Group for actuarial services provided to the COTPA pension plan for 2019 through 2020. And we just received the results of that work. And the invoice was for, I believe, $10,000.
I'll make the motion to approve. Sprint.
Jesse Brown, second.
Heather, can you take the roll call?
Yes, sir. Jason Fairbrush,
Aye.
Brent Bryant,
Aye.
Matt Boggs,
Aye.
Chris Burke,
Aye.
Jack Murphy, Jesse Brown,
Aye.
Lamar Hammond,
Aye.
Steve Lawley,
Aye.
Mike Shaw.
Aye.
Okay, motion passes.
Okay, item 12, approved payment to Allen Gibbs and Hulick, basically AGH. This is our auditor for audit services for the COTPA pension plan for the 2019-2020 year. That invoice should be in front of you, $14,631.30. So can I get a motion to approve this payment?
So moved. Mike Shaw.
Okay. Can I get a second?
Second, Chris Burke.
Chris.
All right.
Okay.
And I'm sorry, I'm gonna pause here. So we have not paid this bill. That's why it's not a ratification. Is that?
That's correct, sir.
Okay, just double checking. That's all right. So can I get or Heather, we're ready for the roll call vote.
Okay. Jason Fairbrushed,
All right.
Brent Bryant,
Aye.
Matt Boggs,
Aye.
Chris Burke,
Aye.
Jack Murphy, Jesse Brown,
Aye.
Lamar Hammond,
Aye.
Steve Lally,
Aye.
Mike Shaw. Motion passes.
Alrighty, item 13 then, receive the COTPA interim financial statement from 7/1/20 to 12/31 of 20. And I know it's Amy and her group that works on this for us. Is that right?
Yes, sir.
So we appreciate your work on this. This was presented to the COTPA Board of Trustees during our March meeting. My main comment on this, I know we've talked about a lot of financial information today, but as I had suggested to the trustees, to at least take a look probably at the management discussion and analysis. I think that's always a good summary that accounting puts together for us. And I don't know, Amy, do you have any comments or anything to add with regards to that report?
No, sir. This is the one that we just do in December that's actually separated from COTPA, whereas in the audited one, you guys get it combined with the COTPA one. This one is actually just you guys's, but net position's up $2 million, and bottom line, that's good. Keep moving in that direction.
All right, thank you, Amy. Can I get a motion to receive the COTPA interim financial?
Matt Boggs, I've moved for approval.
Second? Can I get a second, a motion? This meeting's been too long, I'm sorry.
Brent Bryant, I'll second it.
Thank you, Brent. And Heather, how about a vote?
Jason Fairbrushed,
Aye.
Brent Bryant,
Aye.
Matt Boggs,
Aye.
Chris Burke,
Aye.
Jack Murphy, Jesse Brown,
Aye.
Lamar Hammond,
Aye.
Steve Lally,
Aye.
Mike Shaw.
Aye.
Okay, motion passes.
All right. Item 14 on our agenda. Is there any old business?
Jason, just want to make you aware, and actually Deonda is in with Heather. We did have 2 retirees that passed away in this last month. And Deonda, I apologize. I did not have any interactions with them, but I believe Deonda may have those names.
Don Clark and Joe Haddad.
Mm-hmm.
Oh, man.
Yeah, we wanted to let you know, we when we can, we always send something from COTPA when we have a retiree that passes away. That's not always possible when we find out about it, but we do try to send something. So wanted to let you gentlemen know about that. And I believe that is it for old business.
All righty. Item 15 is new business. We've kind of had one item brought up. I did want to, under new business, Mike, can we make sure we as a secretary for the committee, can you make sure you reach out personally to Mr. Murphy and just fill him in and on if he has any questions about any of the business that was conducted today? We certainly don't want him feeling like he was left out. And,
yes, sir. Yeah, I'll call him. I was on the phone with him as we were starting the meeting, so I'll give him a call right after.
And I think for future meetings too, if we know in advance enough, I mean, he's more than welcome to set up here and our conference room, or he can share my office. We're distant. We can distance with masks. So anyway, let's do that. And then the other item of new business, committee member Bryant brought up And so that's the idea of a special meeting rather quickly, as soon as we can get it on everybody's calendars to discuss our actuarial assumptions. So I'll just turn it over to the committee. If there's any, particularly if there's any objection to that, please speak up. Otherwise, I think we'll just plan on getting that on the calendar and having a discussion. Okay.
Completely agree.
Hearing no objection to that, we'll plan on setting a special meeting up with the 2 agenda items that Mike had mentioned earlier that should be reflected in the minutes. Okay, so I think that's going to conclude us. I'll take a motion to adjourn.
So moved.
And a second.
Second. Jesse Brown, second.
All right, Heather, you need roll call for this one too?
Why not?
Well, okay. Hopefully it's unanimous.
Jason Fairbrush,
Aye.
Brent Bryant,
Aye.
Matt Boggs,
Aye.
Chris Burke,
Aye.
Jack Murphy, Jesse Brown,
Aye.
Lamar Hammond,
Aye.
Steve Lally,
Aye.
Mike Shaw.
Absolutely.
Okay, motion carries.
All right.
Thank you all.
Thank you guys. Appreciate it.
Thank you, guys.
Thank you.
Take
Take care.
care.
Thank you.
Take care.
Have a good
All right.